Welcome everyone to the 8th IPRA conference. My name is Hazel Bateman and I'm the President of IPRA. IPRA stands for International Pension Research Association. So we're an international research association created and supported by 3 international pension research bodies. The Pension Research Council, represented by Olivia Mitchell, cepar at the University of New South Wales in Australia, and NetSpar, based in the Netherlands. And we're also supported by the OECD and IOPS. So this is our 8th annual conference, and it's a pleasure to see everyone in person again. Last year we ran a hybrid conference and many people participated online, and the previous 2 years we ran this meeting online. So I'm sure I've seen many of you on Zoom rather than face-to-face. It's terrific to see everyone in person again. When putting together the annual conference, our executive committee spends a bit of time brainstorming what issues in pensions we think will be of interest to this particular group of participants. And also what research issues can be informed by academic research. This year we converged on 3 general themes. Decumulation. Decumulation has been an issue for many years. I first started pensions research 30 years ago, and 30 years ago we were talking about if we had defined contribution schemes, what should people do once they've saved and they're in retirement. We're still talking about these issues. So our first session is on decumulation. Then, as we know, many countries are considering or have moved to asset-backed pensions. And so we decided to have a session looking at the challenges of setting up and maintaining a system of asset-backed pensions. And then in our third session, we had a discussion about the many issues that are facing pension funds currently. And we converged on 3 different topics. And one of these is looking at sustainability preferences. So increasingly, members are asserting their preferences for sustainable investments. Second thing that we looked at was in a world where members have increasing choice and are required to make decisions, looking at the ability of tools to support members make decisions. And the third thing that we're interested in is, particularly in the post-COVID world, the tendency we see of people to acquire debt, particularly as they're approaching retirement. So we'll have a paper looking at debt in the post-COVID world. We also look for a keynote speaker to talk on a topic of broad interest. And Warwick McGivern this year will be talking to us about climate change. So I would like to thank my fellow IPRA executive members for all the support they've given me in putting together this conference. I'd also like to thank the OECD and IPRA and IOPS, OECD and IOPS, for all their support of IPRA as an organisation and also facilitating this conference. And in case I don't get the chance, I'd like to thank all of our speakers for coming here today and for everyone in the audience here for their participation. Now I'd like to pass to Serdar Flore-Anne for her introductory comment.
Thank you very much. Apparently it's ladies first this morning. So anyway, last year we had this hybrid meeting as mentioned by Hazel. It was a pleasure to see some of you here in Paris, and I'd like to say it's a pleasure to see more of you today in person. I think it kind of enrich the conversation, although of course having virtual attendance is very good. So last year I was here in this same place next to Hazel with 2 hats. This time around I'm glad to only have 1 hat. So I'm representing the IOPS, the International Organization of Pension Supervisors, of which I am the Secretary General. As you know, and as mentioned by Hazel, it's been our pleasure with IOPS, the OECD and IPRA, to actually organize on a regular basis, back-to-back, with the June Working Party on Private Pension and IOPS meeting to have this research academic seminar. And we believe that it really enrich you, academics, to have policymakers around the table to actually discuss some of the policy issues that are the core of their work. And at the same time, of course, for policymakers, it is great to have the most up-to-date research on pension being discussed. So I think it's been really a mutually beneficial occasion, and we really welcome the possibility for the 8th time for this to happen. As you know, we have this seminar on an annual basis, usually in June, again back-to-back with the OECD and IOPS meeting, but we also do that through a journal, the Journal of Pension Economics and Finance, and of course we have the co-editors here, and the OECD and the IOPS are actually also supporting the journal. It's been a pleasure. Again, it's very important for policymakers and pension supervisors that I'm representing today to make sure that the work, the regulation, the supervision is informed by the best of research, which really you are. Hazel has actually mentioned the program of today, which I do believe too is of great relevance. You mentioned decumulation. I've been working myself on pension, and some of you may not know that, for the last, now it's been, well, 23 years perhaps. Actually, one of my first subject topic was really the payout phase, the decumulation phase, which, as we all know, is very, very challenging. So I welcome the fact that it's going to be discussed more today, actually, but just also to mention that is a project that is very core of the work of course, the OECD Working Party on Private Pension, but also the IOPS would like to resume some work on decumulation in the future. So we are really pleased that this discussion is on the table today. Second, you mentioned climate change. I would say all of the groups we are working on these days are actually discussing climate change and its impact on pension. But more generally, I'd like to say that at the IOPS, as you know, we have guidelines that are looking at ESG and supervisors and how can supervisors take into account ESG in their strategy. We're in the process of actually developing implementation guidance because it's nice to have high-level guidelines, but actually there are a number of challenges on how to apply ESG strategy. And I'd like to say, with another hat that I have now, that of course climate change is important overall for policymakers, for pension, but also for institutional investors in general. And as mentioned by Hazel, I think importantly we should keep in mind that it is increasingly important for actually the beneficiaries of pension. So making sure that the right choices are made by pension fund when it comes to preferences in terms of investment. So that's my financial education, perhaps hat here, but just something I'd like to flag. Another area that will be discussed today is still the effect of COVID and the resilience of beneficiaries. And of course, this is also a work that has been undertaken by the IOPS and that will continue to be an important focus of the program of work in terms of making sure that especially pension supervision and pension system are resilient and are able to adapt to shock, be it COVID or actually being climate change, because I just mentioned climate change. Another area that will be looked at is the assessment of the effectiveness of supervision and regulatory measures, which of course is at the very core also of IOPS work. So all in all, frankly, I look forward to the discussion of today. I'm sure it will inform further the work of IOPS and I'm sure the OECD, and I'd like to thank you all in advance for your active contribution, thanking the moderators and the speakers in advance if I don't have the chance to do that in person, and wish you all a very good day. And I think I'm handing over to Serdar now.
Thank you, Professor Bateman. Thank you, Flore-Anne, for the opening remarks. I will be very short. We are very happy to host you at the OECD. Of course, we are very happy with the cooperation with the association and also IOPS on organizing the conference. OECD, as you know, is basically our function is to provide, let's say, develop international standards and also to help governments by providing evidence-based policy advice. Of course, in that context, it is very natural that we work with academics, researchers, discuss together. But it doesn't happen always very successful as like in this case. I understand over this 8 years, this is the 8th conference, and the agenda has been very carefully designed. We had on Monday, we had the IOPS discussions with supervisors around the world. Yesterday, we had the discussions with regulators and together joint meetings. When I look at the agenda today, it is highly relevant to what we were discussing last 2 days with only policymakers and supervisors here. So this is really a good cooperation. Again, hopefully we hope to see in other areas of the OECD as a good example based on this seminar. But also I think it is very relevant in this context. Why? Because as OECD and also IOPS, we are also kind of the custodian of some global standards in the area of pension funds. And one of them is OECD's core standards for private pension regulation, but the IOPS standard also the pension supervision, and both of them are currently under review. So the Working Party and IOPS just started to revise them, discussing them. So I think this conference is also very timely in that respect, will be a highly variable input to the review process. So we will hopefully benefit a lot from the discussions today and take back it home and also in the OECD, and we'll use that information, your academic, also the discussion, research, in revising the core standards for the pension area, both for regulation and supervision. So very happy to see many people, many colleagues in the room, and I look forward to the discussion today.
Thank you. Okay, so thank you very much. I would like now to introduce the chair to our first session. Professor Olivia Mitchell, who is from the Pension Research Council and the Wharton School at the University of Pennsylvania. So the floor is yours, Olivia.
Thank you very much. It's a pleasure and an honor to be here with you today. It's a thrill to be back face to face after such a long period of gloom and doom. But with that, let me add my thanks to IOPS and the OECD. IPRA is very privileged to be able to have this association. We learn from all of you, and we look forward to continuing to communicate with you. During this session on decumulation, we have 3 excellent speakers. The order of discussion will be that the first 3 speakers, James Banks, Abigail Hurwitz, and Peter Hieber, will be presenting their work to us, 20 minutes each, and then we will have a combined 30-minute Q&A discussion at the end. Let me say just a couple of words about our speakers. James Banks is a professor of economics at the University of Manchester and a senior research fellow at IFS, where he co-directs the Center for the Macroeconomics Analysis and Public Policy. His other job, or one of many, is to be co-principal investigator of the English longitudinal study of aging. This is a sister study to the health and retirement study, which I am part of in the US. And he's actively involved in working with policymakers and researchers on activities regarding the importance of the use of individual survey data for making policy. Our second speaker is Abigail Hurwitz. She teaches at the Hebrew University of Jerusalem, and her research is dedicated to long-term saving, consumption, and annuity choices. And she's recently worked on annuitization and other related topics in Israel. And our final speaker is Peter Hieber. He teaches life and pension insurance at the University of Lausanne in Switzerland. He's a qualified actuary and a member of the German and Swiss actuarial societies. So we're going to be looking forward to him speaking on Tontines. So with that, let me first turn it over to James Banks. You have the floor, and I believe your slides are right before you.
Terrific. Thank you, Olivia. So just to add my thanks to everybody organising this, and it's a pleasure to be here today. I think it may even be the 2nd or 3rd time that I've spoken at one of these meetings, but many years ago, so it's great to be back. I want to talk today at a very high level about the decumulation phase of the life cycle, for want of a better word, and thinking in particular about how financial literacy, cognitive decline, and issues around aging for people factor into those decisions, or should factor into those decisions. And I start, and maybe I'm being unfair here, but my take, I mean, I've been researching on pensions for the good along with most of us on this table for the good 35 years now. Not everybody. But most of the debate on populations, ageing and savings has been about the need for people to save more to finance their longer retirements. And we mustn't forget the decumulation phase of the life cycle, because people, when they get to the retirement, they still need to manage their money. This is what we're talking about in decumulation. Oh, I've gone the wrong way. And those retirements are increasingly long, which means that the ages at which you're going to have to manage your money are increasingly old. And that's what I really want to be talking about. And at the same time, what we, and certainly we in the UK, but we in many OECD economies, what we're asking them to do is becoming more complicated than it used to be. So really this talk is going to discuss some of the issues that arise in that area for policy makers. I should say this is work that I've already written up and published just last summer in the annual reviews of economics. So there's a link in the slides for anyone who wants further information, because I can really only talk at a very high level in the 20 minutes I have today. So I'm going to start just with I don't really need to spend much time here for this audience, but I always like to start with the microeconomic context and the macroeconomic context. And the microeconomic context is that individual people need to face up to the reality that not just are they going to live a long time, but they're going to be quite old. And that people sort of think, well, isn't that obvious? But I suspect it hasn't really been that obvious for a lot of... So this is a chart that we pulled from the paper. It's an actuary. It's just the life tables. I'm not going to explain it to you. It's essentially the widening distribution of probabilities of dying at older ages. It's too complicated for this talk, so I summarized it in a separate chart. And this chart looks at the chance of a 60-year-old, on the left, if you focus on the left-hand panel, for those in the room, the chance of a 60-year-old living to age 85. And in 1970, for a male, that was about 15%. And by 2020, that is now almost 50%. Okay? So that's this is, I'm not talking about babies now. I'm talking about the people who are about to retire. Half of them are going to be living to 85 plus. And in fact, if you look at the proportion living to 95 plus, it's going to be, you know, kind of 15 to 20%. So for all people in the economy, they're going to, you know, on average, or a lot, they're going to have to be dealing with prospects of taking financial choices well into their 80s and probably into their 90s. Okay, and these probabilities are going to be rising over time. And this is a chart from some of my work that I've done over the last few years, which looks at cognitive abilities and how they change with age. The distribution of cognition, with the green bars in this chart representing the people who perform best in our cognitive tests. And these are people who can do compound interest and percentages. And you can see that even in their 50s, this is a lot what we talk about, retirement literacy, cognitive ability. Even in their 50s, only about less than 25% of people in England can do compound interest. But we've got another 25% of the population that can at least do percentages. But what happens as you get older is that those groups decline. And you're getting people who are making more mistakes, and this is not people would say, is this about the cohort effect of the people? This is not what's going on here. If anything, you'd expect those effects to go the other way. So, you know, we see this decline in cognitive ability with age, okay? And to really quite small levels, by 80 plus, we've only got 1/4 of the population that can even do percentages. Okay, and remember, 80 plus is that age that now most people have got to be planning to live to. So that's the microeconomic concept. If we're thinking about modeling people's life cycles, what do we have to do? What about the macroeconomic concept, which may be more relevant for some of you guys around here? Well, the first thing is, the fraction of the, I mean, obviously it's going to follow from the microeconomic, the fraction of the population about to be 75 or over is just about to start rising rapidly. I mean, for the last 20, 30 years, we've been saying, oh, the number of 65-year-olds is about to start rising in 2015 or 2010, depending on, and we see we've got to prepare for it. And people have been, in different countries, either preparing or not preparing for it, but at least that's what they've been saying. But the corollary of everybody becoming 60 and over, or 65 and over 10 years ago, is that they're all just about to start becoming 75 and over. So this is the fraction of the population 75 and over in 3 economies plus the OECD. I've just taken from the OECD stats. And if you see, we're just at the point where the lines kink. The fraction of the population 75 and over is just about to start rising rapidly, and it's going to rise very rapidly over the next 10 to 15 years. So an economy is about to have more people who are 75 or 80 and over, not just people who are 65 and over. Okay? So there's going to be more people with lower cognitive function, and at the same time, we are pushing more wealth into defined contribution saving. So this is the rise in defined contribution pension assets as a function of GDP. I don't need to talk to you about that. And the alternative is the fall, if you like, of pension assets that are held in DB. Okay, so this is even over the last 20 years, you've got different points on this. You know, Canada falling, all countries essentially, the fraction of their pension assets in DB are falling over time. Okay, so we've got more people, and we're giving them more money to manage. And that's really the problem that I want to be talking about. So what do we know? Well, it was worth thinking about, you know, what do we know about the decumulation stage? And the answer, unfortunately, despite the fact that a lot of us have been saying it's very important for a long time, is not much. Okay? So looking at the big picture, you could say what we think is that wealth decumulation is pretty slow. And by slow, I mean slower than we think we economists think it should be. So if you look at trajectories of wealth in the panel studies, if you look at it in the registers, typically you see wealth decumulation post-retirement being slower than a standard life cycle model would predict. And that's particularly true when you look at housing. So certainly in the US and the UK at least, you know, you see really low rates of downsizing and a reluctance to essentially convert your housing wealth into consumption. So that's the first thing that we know. The second thing that we know, probably related, the annuitization puzzle. People are sort of reluctant to annuitize. And there's a lot of work, I'm going to come to this later, on some of the more recent policy reforms in annuitization that hint at this as well. But it's been around forever. I mean, lots of us have worked on it. So, you know, we have thin annuity markets and a reluctance of people to annuitize their wealth. And the final thing, and this is, I've written here as a broad point, but it sets up a more specific point, is that, you know, to me as a microeconomist, as opposed to a financial economist, I don't think of specific assets. I think of people trying to manage their lifetime utility. And we really need to think of that as one holistic problem. What people really want to do in their retirement is to manage their flow of consumption through their retirement. And when you think about that, it's not necessarily about wealth or an annuity, it's a portfolio problem. When you're old, you have a whole bunch of different risks. Health risks, long-term care expense risks, you know, longevity risk, obviously, but then there's other demographic risks about your spouse or your children. There's a whole bunch of different risks, and really the way what you're doing is combining all these products, the government first-tier pension, your health care, your long-term care insurance, your private pension, your savings, to try and smooth out your consumption profile. And so a lot of work has then looked at these consumption profiles and say, are they smooth? And it turns out that, you know, as always, the answer is sort of yes and no. If you just look at the data, you say, well, they don't look very sensible from a risk management perspective. But if you start to make a more complicated model, if you start to have a model with enough risk aversion, with a bequest motive, with healthcare expenditure risk, and actually I left it off this slide, but it relates to the annuities points, with subjective life expectancy policies. We're going to hear more from Abigail about that later. Then you can begin to say, well, maybe these consumption profiles, they do look a little bit like they're consistent with some kind of life cycle smoothing plan. But it's still, I think most people would agree, it's still pretty hard to sort of really say that's persuasive. And if it is persuasive, it's only really true on average. Like for an average cohort of people born in the 1940s, we can sort of argue that the average consumption smoothing profile is consistent with, a sort of rational, if you like, smoothing model. But it's pretty hard to do that. So, but really, partly because it's difficult with data on people at older ages, and partly we don't have that much data, there's been very little really work on this, and I've done quite a bit of it in the UK, and it's been rather inconclusive. Now, more recently, we have had specific events, particularly I'm going to talk about the US, UK, and Australia, where we've had DC pension assets and people's opportunity to withdraw them, where people have studied the drawdown or the accumulation phase of the pension assets themselves. Now, all countries have got different, I don't need to say this, all countries have got different approaches and different restrictions. So again, I'm going to summarize very briefly, but broadly speaking, if you look at Australia and the US, I would say my reading is that, again, drawdown is pretty cautious. People sort of do the minimum, like when they're forced to, when they hit the age where they have to start drawing down, they typically do. They don't do it before then. They typically, in the US, they typically use the required minimum distribution rates. They don't typically go beyond that. So, and the same in Australia, really. Some people are, but on average, I would say most people are doing the minimum amount that's required or permitted. So far, that would be consistent with the smoothing literature that I was talking about. The UK has been different, right? We went the other way. We had mandatory annuitization and we got rid of it, at least for the second tier part of the pension. And so it's quite interesting to see, and obviously the UK is something that I know more about. So I thought I would just put up two pieces of evidence on UK before moving on to the sort of bigger way forward. So the first thing that we know about the UK is that even with pension freedom, so we have a large cohort of people in there between 50 and 65, they're all able to annuitize, they've got no restrictions, they've got a lot of DC wealth. What do they look like? The first thing that it's very apparent is that they basically don't know what they're doing. I'm not sure whether you can see this. It's probably a little bit too small, but the chart, the table on the top shows that what sources of information have people got about their DC wealth. The first thing that the table shows, I'll just tell you the headline figures, is that half of the population in the survey don't even know what their DC wealth is worth. Of the other half, you can divide them into three groups, the poorest and the middle and the richest. And even in the richest group, the richest group is the only group where you see even 20% of the population taking any kind of financial advice. So essentially, all information they have is from the scheme reports, the thing that you get in the post that says this is how much your plan is worth, which obviously half the people forget. And that's basically it. And if you look at the people in the lowest third or the middle of the DC wealth distribution, 6% of people getting financial advice, 6%, 7% getting information from pension representatives, a few getting something from their employer. But basically, it's just that scheme report. Okay, and then in the bottom table, the chart looks at people who have actually gone into the decumulation phase of their pension. So this is by pot size. So the left-hand chart is people with pension pots of less than £10,000. That's small amounts. And the right-hand side is people with pension pots of £250,000 or more. That's the big amounts. The bottom chart is the bottom blue bar is the fraction of people who seek advice from a regulated advisor. The middle one is the people who seek advice from the government's pension regulator, and the top are the people who've got no advice at all. Okay, so the very richest are, in the very richest we've got 3/4 of the population getting some kind of advice. But further down the distribution, we've got basically nobody. And what are they doing when they get their pots? Well, it turns out they're kind of, it's obviously there's a massive heterogeneity. Some people are taking out a lot, and a lot of people are taking out a little. So this is what they're doing with their pots. Again, the same. The left-hand figure is the small pots, less than £10,000. The right-hand figure is the large pots, only over £250,000. And this is the withdrawal that's happened from their pots in the first year following the ability to annuitize, right? The ability to take drawdown. So the grey bar is people who've taken out less than 2%. So they haven't really touched it. The brown bar is people who've taken out more than 8%. So they've basically, started dipping in pretty big. Okay? Now, if you thought of a sort of standard annuity model, you wouldn't necessarily think that would be the right answer to any, most people defaults would be, we want it somewhere in the middle, 4s, 5%, whatever. We've got really vast heterogeneity in the distribution of these things. We've got a lot of people taking out more than some people would say was relevant, a lot of people taking out less, and very different over across the wealth distribution. So that's what we know, which is not much. So I'm going to finish by saying, what do we need to know? So, key issues for financial choice at older ages. So first of all, I've already said, the optimal decumulation rate is complex and heterogeneous. We, as policymakers, would like to know what it is, and then we'd like to try and convey that to the savers. Even though that's going to be very different answers for different types of people. I'll come back to that with my final conclusions. Secondly, what information does the individual have? How much do they know about their own underlying health and longevity risks? One of the things about DC rather than DB is that you move the point of contracting from the beginning of life, where both the individual and the insurance company are equally ignorant. So that's great for markets, because equal ignorance means insurance market works. Suddenly, we suddenly make these decisions when people are 75, when potentially individual has got a lot of information about their longevity risk, a lot more problems of adverse selection. So they're learning, and that's going to affect the market. There's also the issue of broader financial literacy. So, you go through your life thinking about financial products, and even if for the people who know about the financial products they had in the accumulation phase, suddenly now they've got to start learning about a whole different set of options that they've never had to know about in the decumulation phase. I've spoken briefly about declining cognitive abilities. So that's going to be correlated with wealth. We just don't know how much. So, when does the cognition start to decline for a high wealth, high defined contribution pension holder versus a small, low wealth person? Who's taking an advice? What determines it? When do they take advice? More generally than advice, who makes or helps with the people's decisions? We're probably all in this situation where our parents are going through this and children begin to help. That raises issues around, if you think about issues around ethics, issues around trust, issues around who gets help, and there's a whole set of issues when you get delegated decision makers taking decisions on the behalf of older savers. Financial capability, especially online. Most products in the UK now have to be managed online, and even like, say, my father, who worked in financial industry the whole of his life, is incredibly financial literate. He's terrible at internet banking. He still likes to go into the branch and talk to somebody. And finally, vulnerability to fraud. These are things that we really haven't spoken about that are going to be much bigger going forwards. Okay, so I got the stop sign, so I'll just give my conclusions. So, the DC provision literature implicitly acknowledged individual risks. That was the point of it. We wanted people to take risks. But the acknowledgement of the risks was more on the asset returns and the asset pricing side, less than, or not so much on the decision-making side. And when it did acknowledge decision-making risks, it basically was doing that on accumulation. This idea that the financially less capable were not saving enough. It didn't really acknowledge financial literacy and decision-making risks at older ages when people have to take more complex decisions. So what do we need to do? Firstly, in that smoothing literature that I was talking about, the macroeconomic literature that looks at portfolios, wealth and consumption, none of that acknowledges financial literacy. We need more new models. The people who do look at financial literacy, they look at, who decumulates what in this pension or who accumulates what. None of that acknowledges smoothing. They look at a single asset rather than setting that office asset into more portfolios. So neither of those two literatures are sufficient to help with our problem. So we need, first of all, we need to join those two literatures up. We need the financial literacy people looking at the whole portfolio, and we need the smoothing people looking at financial literacy. Finally, we need more work on financial advice and financial literacy. For policymakers, so I'm going to say, this is my controversial statement, if you're thinking about using defaults to encourage annuitization, changing statutory withdrawal rates, or even encouraging different forms of DC collective pension, I'm going to say you haven't got enough evidence to do that, to understand the welfare implications of that. So what can you do? Well, it's the same thing I think I've said here before. Keep it simple and keep it stable. Because one thing we know is that decision-making is difficult, and it's going to get more difficult with age. So if you don't know what to do, simplicity and stability from one year to the next is at least something that you've got on your side. So I'll leave it there.
Thank you very much. We will have Q&A at the end, so please write down your questions, and we would like to turn the mic over now to Abigail Hurwitz, who's going to speak on testing methods to enhance longevity awareness.
Okay, so first of all, thank you very much for the organization and for giving me the opportunity to discuss this work. This is a joint work with Olivia and with Orly Sadef from the Hieber University as well. And in relation to the previous presentation, the effort that we are doing, this is just one paper out of a larger effort, is to see what people know and what people understand about their own longevity. And what can we do to enhance their awareness, which is obviously very important. So we know from previous studies that people do have some idea, and they devote time to think about how long they will survive. And these estimates are very important. They're important for various financial decisions, such as saving, decumulation, annuitization, claiming Social Security, and others. And I think it's clear in this room that it's not only important for researchers, it's also important for policymakers when thinking about financial behavior around retirement. So in this specific paper that was also published already, and I'm happy to send you a link afterwards, we ask three main questions. The first one is, how do people estimate and use subjective survival probabilities when they're making long-term financial decisions? Our second question is, can we give them information? Can we enhance their awareness somehow? And the last question is this, like, does it matter? So if we give them information about life expectancy, about longevity, can we influence their financial decisions? Which, you know, is the goal of our efforts. So really briefly, we know that people devote some thought to their potential longevity, and we know that some people have systemic biases when they're predicting their own longevity. I only have 20 minutes, so I'll be very brief. We know that some groups are overly optimistic. We have some other studies about this. And that people do consider their own personal characteristics when they think about their future life expectancy, their future longevity. We also know that some people avoid thinking about this. It's called in the literature death denial. They're not likely, and they don't want to think about their future survival probabilities. So this is a preview of the results from our study that I'm going to show you. So the first result is that merely getting people to think about their financial behavior can alter their survival probabilities. So this is the first result. The other one is that when we provide information, longevity information, to people who are pessimistic about their survival probabilities on either life expectancy or longevity information, we can affect their annuitization choices. And since this is a panel about decumulation, I think this is an important result. And I think these kind of results can be useful for policymakers when thinking about how to change behavior. Okay, so in the study, we designed and fielded a nationally online survey in the US. Our participants are aged 35 to 83, so we have people in various age groups. We start by measuring their subjective survival probabilities and their longevity risks, and we compare those with life tables to see whether our participants are optimistic or pessimistic comparing to life tables. Then we assess various methods to boost their awareness, and we use a prolific platform. We compensate participants. The approach we use in this study is a vignette approach. Vignettes are short stories about hypothetical persons confronting a similar question. And typically, when researchers use this vignette approach, survey respondents are asked to provide an advice to this hypothetical individual. In the context of our study, we asked participants to provide advice about savings and about decumulation, about annuitization. In terms of the experimental design of the study, as mentioned before, we asked people to provide advice about either saving or annuitization. And we provided to about a third of our participants life expectancy information, whereas about 1/3 of participants received longevity information, and some received no further information about either. We also varied the order of the question. That's important because some of the participants were asked to advise and were given the information before asked about their own subjective survival probabilities, while some were approached the other way around. And I will show you in a few minutes, I don't have that much time, that the order matters. So, as I mentioned, merely getting people to think about financial decisions that are relevant for old age made a difference. All in all, you can see that we have more than 5,000 individuals here, and this allows us to have various treatments. So I'm not going to read the whole story to you, but this is the annuitization story. It tells about a Mr. Smith. By the way, we also had a Mrs. Smith that saved an amount for retirement and needs to decide how to withdraw his or her savings. And we first gave the participants just two options, whether to entirely withdraw the amount as lump sum or as an annuity, and then we gave a middle option as well. And similarly, we had a story about a Mr. Smith who is confronting the decision of whether to increase his saving levels. In terms of information, we exposed participants to both information about average survival rates, life expectancy. That's the first sentence here. Please note that an American man, 65-year-old, will survive 18.1 more years on average. The other group of participants were informed that 22.3% of American men 65-year-old will survive to age of 90 or more, and we just heard that this percentage increases over time. So as mentioned, we had 5,108 participants. Some of them did not answer the vignette question. This is why about 90 people were not in the previous table. And you see that we had like half of them are male and a bit less than half, and 58 are married. You can see their education level, and etc. One important point is 85% of participants believe that their health was good, very good, or excellent. This already tells us that they are quite optimistic, right? This is, and we have some more work about this. So I have another paper using Israeli data showing about smokers and accumulation, and we have data from an insurance corporation, and we show that smokers are not less likely to annuitize, and 79% of smokers think that they will live at least as long or more than the others. So, first result. What you see here is the mean difference between responders' subjective and life tables probability. This is basically their optimism. And you see blue bars and red bars. The difference is whether they saw the information before or after being presented, being asked about survival probabilities. So those in the red bars saw the information, like the vignette and the information before being asked about survival probabilities. You can obviously see that the red bars are lower, which means that being asked about financial behavior changes your survival probabilities. You can also see that the right red bar is higher and significantly higher. So being provided with longevity information, not life expectancy, just longevity, changes your survival probabilities. And this basically shows the same thing with regression. One of the potential explanation, and this is just a Google trend figure, is that people are already aware of the mean life expectancy. What you see here is the amount of searches for life expectancy and longevity using Google over a long period of time. It's very small, but it starts in 2004. And the blue line represents longevity, while the red line represents life expectancy. People know something about life expectancy, but longevity, less. And how does this affect financial decisions? So we're not very happy to report that survival expectation does not affect savings decisions, but when we look at those who underestimated their survival probabilities to begin with, both life expectancy and longevity information changes recommendations about annuities, about the decumulation. And I think this is the main and the interesting result from today. So to conclude, when we provide people who understand conditional probability information about their likely longevity, we see that we change their subjective survival probabilities, while when providing life expectancy, we don't find an effect. It suggests that people probably understand the mean survival changes, but they don't understand the right tail. The numbers presented here before, that there's a high likelihood of them living to a very long age. And we provide novel evidence that merely getting people to think about those financial decisions alters their optimism. We also provide evidence that when we give people who underestimate survival probabilities this information, we can affect their annuitization choices, and we think that this is important both for research and for regulation. One more point. This is merely part of our effort to understand longevity awareness. I mentioned that the paper I presented now was already published. We also have a paper about awareness to the changes in longevity during COVID, We have a paper about the racial and ethnic aspect. And we also have a working paper about financial regrets at older ages and how they are affected by longevity awareness. So that would be it. Thank you.
Thank you very much, Abigail. Continuing, we have a paper on the role of tontines in retirement decumulation by Peter Hieber from the University of Lausanne.
So, hi everyone. Let me start just with a question to you. So, who of you has heard the name tontine before? Okay, a few of them. Okay, good. So I will explain you a little bit for the others what is a tontine, and I will explain you also why a tontine is very relevant for you if you do pension reforms in certain country where this appears, and I will then review the academic literature in the last 5 years on this subject. So first of all, in a traditional insurance contract, there's always somehow an insurance company, insurance provider that guarantees you in a defined benefit, say 1 unit for life, €1 for life. In a tontine, things are different. In a tontine, it's just a pool of policyholders that shares risks, so there is no insurance company in this. And this would mostly link to like a collective defined contribution scheme. So that's what I'm actually talking about. Okay, so my agenda, I will motivate this a little bit, and then I will show you different ways on how to implement a tontine actually. So how to find cash flows in a tontine. There's many, many different names for tontines in the literature. So there's like pooled annuities, survivor funds, group sales annuitization, or general like mutual insurance. So one needs to be a bit careful. It's somehow hidden everywhere, these tontine schemes. And tontine schemes were in fact the very first insurance products. Like 300, 400 years ago, everything in life insurance was about tontines. And it might evolve, so the evolvement of collective defined contribution and also the digitalization, which makes it easier to implement such schemes, might get some similar popularity soon. So the popularity is clearly rising. And we in academics, we try to also learn from these original products. Like there's some recent books and papers that look at the original tontines. But we want to also develop some kind of modern version of tontines and see how this can be implemented in pension designs. And there was some article just like 5 or 6 years ago in New York Times, so one title page, when others die, tontine investors win. And this gave some popularity and more common knowledge about tontines, and this started a lot of also research in academics on this. Okay, so let me give a simple example. So this is just 8 people representative, so it should be 1,000 people that are here. And they, like starting retirement, they invest into a tontine. This means at the beginning they provide some funds, so they provide a premium to a pool there. And now for mortality, now this pool pays out a lifelong income to survivors. So after a while, everybody who is there might receive payments. To survivors, another option would be it also pays disability benefits to people that are injured. You see the guy has lost his leg here, so then he gets some additional payments from the pool. So these tontines might have 2 parts. They might get a lifelong income and they might get additional disability benefits. I will get to this in the end of my talk. So this is the lifelong income. The people that are crossed is like the people that died from this, so they will receive nothing anymore, so they lose their money to the others. That's like how generally pensions are designed. So the difference to a traditional insurance product is that there is no insurance company that gives some guarantee. So if more people die or less people die than expected, then you have some kind of volatility in your pension payment there. Okay. Maybe I go back. So, and then of course here is the combination between the two. So the guy that lost the leg gets then 2 times as much as the other parties in the pool. And we will see in a minute on how such cash flows can be defined and why it's actually good to have at the same time disability benefits and like these lifetime benefits. Okay. So I put some like trend slides. So in life insurance, there is some tendency to have more transparency, more cost efficiency. Traditional life insurance is not very transparent. There's a lot of problems there. And there is this tendency to have a defined contribution. So instead of guarantees, we provide these tontine-like products. And the last part is that we have some trend to participate more in capital markets, which is not really the case in some of the traditional insurance products. And you will notice, so there's the PEP regulation from you somehow that looks at these products, and some of these aspects are contained there. And I will now give you some examples on where actually we have these tontine products in real life products in different contracts. So first, there's in Canada, there's some superannuation funds formerly named Q Super, and this contains nowadays tontine element. It has a quite high volume. There is a development in Canada about very payment life annuities. There is CPF Life Scheme, which is some pension scheme in Singapore. There's an old product Le Conservateur in France, and there's Tontine Trust in Ireland. So that's small things that are starting step by step, but more and more companies move to collective defined contribution, move to tontine schemes. And presenting to a lot of countries here, so I'm happy if you send me emails about your country and if they have some similar products there, because we're comparing this and getting there. Okay. So far, a bit of the idea of the products, and now how do we actually design such a product? So how does it work? How does the payment, how does cash flows work in these products? We look at a very simple session, so we want 1 unit for life to everybody in the pool, and we pool also different cohorts together. So we pool 65 years old and 80 years old together in one pool and want to design cash flows with this. And we have like a multi-period scheme, so at annual time points there's payments. And I will not talk about financial risk. I want to really focus on mortality risk, longevity risk in this excerpt here. Okay. So now there's 3 main parts in the literature on how to design a pool. And I will mainly talk about the first 2. The first one is about, I just define as a provider, as a pool, I define a financial cash flow to the pool. And this financial cash flow goes over time, and it's shared among survivors in the pool. The second possibility will be every individual in the pool has his own bank account. He withdraws each year from the bank account. If he dies, his bank account is distributed among the others. Slightly different approach, but it looks in the end similar, sharing in a pool. And the last aspect is I define a cash flow over time. Then each year I look at realized mortality and the mortality I have from my mortality table. If there is big differences, I adjust my payment over time. Okay. So first, this is an important graph. This is the first part. I have a coming cash flow to the pool. So on the left figure, you see like from a 65-year-old pool, they get a cash flow that's decreasing over time because I expect more and more people to die. And this pool is deterministic. I have deterministic financial risk, and it's shared among a pool of individuals, so it's like every survivor receives a payment from the pool. And this decrease of the line on the left-hand side is designed in a way that on average, an individual will receive 1 unit for life. So it's decreasing relative to the survival probability that's coming from the mortality table. And you will see the left hand is secure, there's no risk for the provider. But the right-hand side, the individual view, is risky. So especially if pool size, so it's just one pool of 65-year-olds, if pool size decrease, say at age 100 there's only like 10 left, then the volatility is very high. So there's high risk if there's 1 people more or less dying, so that's a bit of a problem. And that was the problem of the historic tontines, actually. And so now there is ways to work around this. So there's ways to combine defined contribution and defined benefit somehow. We suggested, for example, a product that's called a tonuity. So it's a tontine in the beginning of retirement, and it moves to an annuity for very high ages to make this volatility increase somehow not a problem anymore. Okay. The second part I want to show you is now to come around this decrease at old ages. I want to keep the portfolio size high. So I want to let people join the scheme later to have the portfolio sizes big. And that's what we do with the individual accounts. So everybody who joins this product provides a premium in the beginning, provides an account, then he withdraws from the account, and he receives on top of this what is called a mortality credit. That's the account of those people that die from the pool. And we want to design this in a way so that he still receives on average 1 unit for life. Okay. So I have some formulas here, but don't worry a lot. So Cj of 0 is the initial premium the person has. each year this account value increases by a financial return until the end of the year. And then at the end of the year, we do accountancy, and first this person withdraws from his account a fixed amount, and then we see who died in this year. We sum up all the account values of the death members. So that is here X of T is just summing up over the account values of all dead members. And then we need to see, this is like the cake we have, we need to distribute now this X of T to the individual survivors. And therefore we introduce some kind of distribution rate, which is the beta J. It's a function that distributes this survival, this mortality credits, to the individual J. And then this individual J receives the fixed withdrawal from its account and the mortality credit beta J of XT of all the deceased members. And maybe I can immediately go to the figure that we have here. So you can see here a figure. So the fixed withdrawal each time is the gray line. It's decreasing with age. So if you're young, you withdraw a little bit more and you receive a little bit less mortality credits. And if you get older, then you receive more money from these mortality credits. So I want to design this scheme in an actually fair way. And what does it mean in an actually fair way is how do you design the beta function? So in the middle, this equation 1 gives you the expected mortality credit somebody receives. And this is fair if it's relative to your account value and if it's relative to a death probability. So if you have a higher death probability, you receive on average more mortality credits. If you have a higher account value, you receive on average more mortality credits. And that's the key formula of this scheme. So somebody who is older receives more, and somebody who has more account value also receives more. And if you have this formula satisfied, you can pool different cohorts, and you can pool like people with a high contribution and people with a low contribution. And the second thing this beta J function has to satisfy, the sum of all the mortality credits you can distribute, you just distribute this amount of money. So the sum of the beta J's equals the money you have to distribute. So that's the two things that have to be satisfied. And one example, so a very simple example of the beta J could be, you just multiply your death probability times your account value, and you divide by the sum of all death probabilities times account value in the pool. This gives you somehow a percentage number between 0 and 1, and then this is your share from the mortality credits. This would be the simplest thing. We look at many of other rules like this. Okay. And if you now do this, and then you implement the scheme, we determine the gray line, that's the fixed withdrawal over time. And you can see here on the left-hand side a 65-year cohort, and on the right-hand side an 85-year cohort. And they share together in the pool. And the 85-year-old has to provide less, the withdrawal of the 85-year-olds is less, but the mortality credits are more. And this way it's come together in an actually fair way, this is shared together. And I will show you two views. The first view is the view of the insurance company. And now at each point in time t, each end of year, you just sum up the account values of the individuals in the pool. And it's very nice that this is equal to the discounted payments to the individuals in the future. And there's no expectation around this. This really holds with equality that the random cash flows in the future, they are discounted and they add up to the current account values. So this means the product is fully funded at all end of years. That's from the insurance provider perspective and shows the effect that there's no risks to be taken by any insurance provider here. And the second thing we have, from an individual viewpoint, the individual has his account value, and this account value is equal to the expected discounted future payoff of this person. You know this as a premium equivalence that's usually satisfied when you start a contract, but this really holds at each year in points. So that's why at each year it's fully funded and it's fair for an individual. And this makes then the possibility to let people join the scheme later on and to keep portfolio sizes big and then to reduce risks there. Compared to the historic tontines, we now have a modern tontine that would be implementable in a pension product. Okay. So I will now go a little bit further and come back to the disability rider I showed you in the beginning. So why does it make sense to not only have a 1 unit for life in health, but also to get some kind of long-term care rider? So say you get twice the payoff if you get into disability because you have more need for more money. And why is this good? Because mortality and long-term care or morbidity risks, they're negatively correlated. If you get disabled, you live a shorter lifetime. And that's why it's a little bit fair to give these people more money than the people that live like in a healthy life. And if you do this, you reduce adverse selection because somebody who is ill will also want to buy this product. Whereas if you just guarantee 1 unit for life, somebody who's ill might not want these products. And so we want to implement this scheme, we take mortality tables that take into account dependency. So you need to have some rule that makes somebody dependent or not. And if somebody is dependent, we use a mortality table that accounts for the higher mortality of being dependent. And if you have a higher mortality of being dependent, you get a higher mortality credit. So that's why based on you can assure that somebody is like dependent or not and that you have a higher mortality rate there, you can implement the scheme from before just the same way. So this is like this. We call it a modern life care tontine in analog to life care annuities that are a little bit sold in some countries. And you see the guy that lost a leg receives 2 times the amount from before. Okay, and this is how it looks like. So the right-hand person after 15 years moves into dependency, and this then doubles the payoff to the pool here because it's more mortality credits than before. Okay, some comments before I conclude. So I ignored in this talk, I focus on the mortality risk for this short period. Of course, one needs to also look at financial risks. It's good in the scheme that the actual variance allows people to join later to this. And there is maybe some work to be done to see that we can update mortality tables over time, because it's not good to fix the mortality table in the beginning and then like 20, 30 years later mortality tables might change. But we can do this because the mortality tables just define on how the mortality credits are distributed between the pool. It's always actually fair, so you can update if you agree before and you can upgrade this. And the last thing, in Australia some people want this premium refund option, which is not good from a risk management perspective, but which could be included into this account setting, because then you keep a second account, which is your initial contribution, and you're just sharing the surplus that you get onto this account in the pool in case of death. Okay, I put some literature here. So the takeaways I want you from this is that tontines are a way to implement these collective defined contribution benefits. The advantage of this, it's fully funded at all times, allows people to join later. That's important to keep pool sizes high. And it's beneficial to pool mortality and long-term care risks, morbidity risk in such a product. And we somehow forget sometimes about long-term care risks, which might also raise with a rising life expectancy, and the older population might get important and needs to be funded too. Okay, thanks a lot.
Thank you very much.